Hello everybody, this is AK. I'm back, still resting my wrist, and here's another video. In my last video I talked about how I'm still interested in maintaining my T-bill ladder and waiting for opportunities, and how I'm still waiting to add to my positions in the local banks, DBS, OCBC and UOB. Now, of course, some readers and viewers have been wondering, if they should, because interest rates have peaked, and of course the US Fed has indicated an intention or possibility of having 3 rate cuts this year in 2024. And there was a viewer who recently asked me, with the Fed stating publicly the possibility of 3 rate cuts in 2024, do I still think that rates will be staying higher for longer? I say, yeah, I think so. It'll stay higher than it was 2 years ago. And since there's only 3 rate cuts this year, it's going to stay there for a longer time, right? And unless you are saying that those 3 rate cuts will bring interest rates back to zero, which is, well, possible, but highly improbable, or highly unlikely, right? So anyway, then the question is whether it's still good to invest in DBS, OCBC and UOB. And I remember reading an article by Bloomberg just a few days ago about the Singapore banks, and so there are some not so good news and some good news, so it depends on how you want to look at it. It's kind of a middle of the ground kind of report, right? So Bloomberg says that Singapore banks mortgages likely to end 2024 with flat to low single digit growth. That means like all the high growth that we have seen the banks enjoying because of the strong tailwind from rapid interest rate hikes is a thing of the past, right? And but Bloomberg also thinks that the Singapore banks will still be very resilient, right? We keep saying this, that they are well capitalized and they're well run, right? So there is going to be an increasing divergence between Singapore and Hong Kong, right? Singapore is not Hong Kong. Singapore and Hong Kong house prices would likely to continue to diverge, right? And Singapore home growth prices, home price growth might moderate, but Hong Kong could hit a 5-year low, right? And but don't be too complacent lah. Singapore is like Hong Kong in the sense that we're a very open economy. So if a recession should hit Singapore, Bloomberg thinks that home loan losses could reach $1 to $2 billion, right? Then of course the banks, DBS, OCBC and UOB would be impacted, right? But if you think about it, right, in the grand scheme of things, $1 to $2 billion home loan losses, right, for the 3 banks combined, really isn't a big deal. Really isn't going to be a big deal, right? And historically, Singapore's home loan default rates have been low, right? And likely to continue to be low, right? And even in a recession, the Singapore banks, still they would probably want to defend their market share when it comes to home mortgages, because there's a very good risk return profile, right, when it comes to lending money to people to buy homes, right? This very low risk weighted assets, right? And so they are likely going to defend their market share in mortgages, and that the competition is likely to get stiffer. So we have to expect, we have to be realistic, and that could compress their margins, right? And for example, we talk about OCBC, right? Its home loan growth has actually slowed down. It's like 2% growth year on year, which is not fantastic. And DBS and UOB have done better. It's like 3% growth year on year, but also is not something to write home about, right? And mortgage defaults, Bloomberg says, may remain negligible for Singapore banks in 2024, like I said earlier, because of resilient incomes and employment, and that helps Singaporeans weather the higher interest costs. Right, and potential credit losses from mortgages look minimal for the 3 local banks. And they have also said that amongst the Singapore banks, the average probability of default is the lowest for DBS, which is 0.5%. 0.5%, right? So it's another reason to invest in DBS now, right? And the delinquencies for mortgages have been under 1% for borrowers aged 21 years or older, with DBS having the lowest risk. But of course, I say if a recession should hit, then we could see this figure going up, but not by a lot, right? And a probability of a default, or they call PD, is at less than 2% for all the Singapore lenders, right? UOB, OCBC, and DBS. So I think that, like what Mr. Lee Hsien Loong said, we are seeing signs of sluggish growth, but sluggish growth is better than no growth. So if things are slowing down and the banks are cyclical, their fortunes are tied to the economy. So if there's sluggish growth in the economy, there'll be sluggish growth for the banks. All 3 banks are well capitalized. All 3 banks are well run. And even though DBS says, they have the lowest risk of mortgage default, and OCBC has the lowest growth in mortgages or home loans, all 3 banks are good investments, in my opinion, right? And there will be more intensive competition for home loans. There will be more intensive competition also for deposits, especially if more people are buying T-bills. Yeah, but they are well capitalized, well run. They have very good asset, right? Like say, a lot of it is very low risk weighted asset, especially when it comes to home loans. I'm still interested in adding to my positions in DBS, UOB, and OCBC, right? You talk about numbers, evaluations, right? It's like 8 times, 9 times PE, it's more than 5% dividend yields, and that's based on just 50% payout ratio. They retain 50% of their earnings. And in terms of value, book value, it's trading at 1 times, or in DBS case at 1.4 times book value. It's not rich valuation, right? And of course, regular readers and viewers know that I added to my investment in DBS a few months ago at under $32 per share. And that's partly also because I think that there will be another special dividend this year, right? I think it's not set in stone. It's not as if it 100% happen, but I think there might be another special dividend this year. Could be 50 cents. And of course, based on the charts at the time, I thought 31.80 was pretty decent price to enter, but now I see $31 as another decent price to enter, strong support. So my position has not changed. I still think the banks are good investments and will continue to reward the investor for income. And there's also a bit of growth element thrown in. So we don't have to be 100% in growth and give up on dividends, because some people say dividend stocks are risky, right? I won't say who lah. Anyway, that's all for now. If AK can talk to himself, so can you. Bye-bye.